Hello and welcome to episode 1 of the Exponential Show, sponsored by our friends at Multiply Marketing. In this series, we bring you stories and insights from startup founders, investors, and industry thought leaders. For the first episode, it is a pleasure of mine to introduce our very first guest, Gagan Singh. Gagan is the founder and CEO of Vows Global, which is an investor matching platform that also provides a bunch of tools to manage your pre-funding and post-funding stages. Thank you, Gagan, for being the guinea pig on our very first episode. It's a pleasure to have you.
Pleasure is all mine. Thanks, Mayank.
Happy to hear that. So I think the first place that I wish to start is to learn more about your journey.
Yeah.
What got you into entrepreneurship in the first place and how the stars aligned for you to start Vows Global?
Good question. So I'm originally from India, a very small town. Just like typical middle-class Indian upbringing, studied really hard, joined my first corporate job in finance role, worked in India and overseas for the first few years of my career, became a venture capitalist in 2013 when I joined a $25 million fund, managed that for roughly 2 years. And after that, started a company which was actually funded by the same fund with which I was working. So I ran that company for roughly 7.5 years in the capacity of group CFO, raised $120 million for the company in equity and debt financing while I was there. So have a bit of experience on both sides of the table. So this is my background, but to answer your question on what led to this, it's a very interesting story. So I was doing a corporate job in 2012, and that time I was quite ambitious. I wanted to try something else. Right. And I had a mentor who was very financially affluent, and I asked him that, hey XYZ, can you tell me if you have to give me one advice for me to become massively successful, what would that be? And the answer which he gave me has stayed with me till today, which is after almost 10-12 years, is that he said, Gagan, founders have one massive advantage over all the other jobs. And I asked what? And his answer was that you just need to be right once.
That is true.
And it simply blew my mind because I know where he was going with this, because it's not easy to find product market fit. And you'll discover it most of the time through trial and errors.
Right.
But once you discover it, it's sky's the limit for you. And since that day, all my actions post 2012 have been directed towards me starting my own company, and I'm glad it happened.
It's so fascinating to hear that and how one thing led to another in your journey. And I hope this is serving as inspiration for our audiences who are on the fence about being founders themselves. So Gagan, from your story, I understand you've been in and around startups a lot, and including scaling your own now. So in that journey, what are the key stages that you feel you've had to go through, and are there any specific challenges or learnings that you associate with each of those phases?
Again, so I can share my experience from my previous startup, when I joined that company, it was pre-seed, and since then we brought it to Series C, and every stage was drastically different.
Right.
So the first stage is it all starts with an idea, then you work on an MVP, float it out in the market, test multiple versions, and then keep refining it on the go. So, but one suggestion which I have for all the aspiring entrepreneurs is that whenever you're building a solution, try building it in the most non-scalable way possible during early days, because that will expose you to a lot of nitty-gritties which otherwise you won't have access to. Because everybody straight away wants to jump and build a solution without going through deep understanding of the ops cycle and the challenges and the customer requirements. So sometimes I advocate, do not build technology early on, rather than just try doing it manually to the extent possible. And once you discover the full life cycle, then start working on the technology. So that's what we did in this startup. Unfortunately, previous startup, we built technology first and then refined it. So different journeys during early days. But then what happens when you're building a company is that the rule of 3 and 10 kicks in. You know what that is?
funnily enough, I learned it from you, but please, for the benefit of our audience.
It's a very interesting concept which was given by Mickey Tani. If I'm not wrong, he is a CEO of Rakuten. And he said that on an interval of 3 and 10, everything breaks in the company.
Right.
So, for example, your operations, your business processes, your strategies, everything needs to be refined on a scale of 3 and 10. So when you are 3-person teams, your operations would be very different versus when you'll be a 10-people team versus when you're 30 and 100. And that happens very swiftly at a startup because it's a hyper-scalable business operations what you're trying to build. So everything breaks. So whatever system you have built, you have to constantly refine over the go. But once you have discovered that, and that phase is from seed to Series A, I personally feel that's the most fun phase of building any company, because then you can just try anything and everything. There are very few external stakeholders in the company, and you are one of the sole decision makers, and there's a small team, so the speed is there. So it works really well. And after that, you raise capital, and then you reach until Series A. But one important thing at the time of Series A is that you need to find a product market fit by then, or you should find a product market fit by then. So personally for me, raising a Series A is probably or arguably the most difficult round of financing for any company.
I see.
You can use seed money on the basis of optics, but by the time you reach Series A, you need to have a product market fit, recurring revenue, customer loyalty, all those metrics sorted out so that you can raise financing. And most of even if you look at the data, most of the companies fail between the seed to Series A level.
I see.
But once you are able to find it, of course, the future rounds are in order for you to support your growth, which can be through expansion or more products or better technology all around that. So after that, it becomes a bit more monotonous. So personally, I feel this learning curve for any founder is most from seed level to Series A, maybe maximum to pre-Series B, but after that it becomes more like a corporate structure because by that time you have a more sizable operations, you have bigger teams, you have more specialists, generalists. In the early days, everyone is a generalist, but in the late stage, everyone is specialist. So you have people who know their job better than you. So then your role changes. But it's a fantastic journey. Every stage is different, but it's the earliest stage where most of the action happens for our founders.
Yeah, it's a fascinating insight into what the life cycle of a funded startup is. So thanks for that summary. So Gagan, I think the next thing that I want to jump into is this part of the world that we live in. So you've worked, obviously you mentioned you worked in India and then in different parts of Southeast Asia. And it is very common for us and our networks to generalize Southeast Asia as one big market. But as you and I have both realized, having worked here, that it is not homogeneous in nature. There's nuances to working in different parts of Southeast Asia. So can you shed some light upon your experiences with these nuances?
No, this is a great question, Mayank, because many people see Southeast Asia as a consolidated region because individually, apart from Indonesia, I believe not any other market is not big enough. So you need to have a regional approach since day one if you really want to build meaningful business in this part of the world. But again, they are different countries. Indonesia is very different from the Philippines. Philippines market is very different from Thailand. So I'll give you an example from my previous experience. So when I was building Delivery, so Delivery is a B2B tech logistics company. So we started operations in Thailand, then expanded to Indonesia, and then to Philippines. But the growth story in each of the market is very different. And so is the customer behavior. So Thailand particularly, if you talk about Thailand, it is a very difficult market to scale, but very easy market to make money. So for example, we were building technology around logistics. So we used to go to these customers and say, hey, how much are you paying for your existing logistics services? Say for the purpose of simplicity, they say $10 per booking. And we say, okay, we're going to charge you $8. And the response from the customer would be, hey, but I don't want to disrupt my existing operations.
Right.
I'm happy with my vendor. Everything is fine. My margins are still good. I don't really care. So come to me at a later date. At this point, I'm not interested. So despite me offering 20% discount, the customer doesn't want to switch.
Right.
Now you go to Indonesia market and ask the same question to the customer. How much are you paying? They say $10. And you say, okay, I'm going to charge you $9. Indonesia customer will say, start tomorrow.
Wow. Okay.
So this is how different the markets are. Now Philippines is somewhere in the middle,
Okay.
where the customers are price sensitive, but at the same time they're looking for alternative solutions all the time. So what that leads to is, if you look at most of the companies which are regionally present, and they can vouch for it, that their operations in Thailand, in terms of scale, are the smallest, but profitable. And even the customer retention number will show that, because their average cohort, or the customer retention over 12 months period is 75%, 80%, which is very healthy.
Right.
Whereas in Indonesia, you get massive scale, but your customer retention is very low. So I personally feel that, and again, it's 100% my personal opinion and experience.
Right.
I don't want to generalize it, but Thailand is easier to make money, but Indonesia is easier to scale. Profitability in Indonesia will always be a challenge for most of the companies.
That's interesting. So the ball game changes when you cross borders. So it's something to learn, something for startups looking to scale in the region to pay attention to, and hopefully learn along the way.
Yeah, exactly. And also the playbook needs to be different. It's
Right.
not just customer behavior, but also the people's behavior.
Right.
Even the way you manage your teams in each country is very different.
Right.
The unemployment rate in each country is very different. So that obviously there's a parity in the pay scale for the same kind of job that you want to get done. So every country is unique. So that's why there are very few companies only who have been able to crack their businesses regionally. Most of the businesses have strong markets and relatively weaker markets.
I see. Yeah, that's interesting to hear, and good learnings for our audiences as well. We again narrow down the next question from regional to your personal experiences. So you've worked with different startups, you've worked under leaders, you've been a leader, and you've seen regional nuances to the different places you've worked in. So within your experiences, how have you seen leadership styles impact a startup, and how has your own leadership style evolved as you've matured as an entrepreneur?
Oh, okay. Again, an interesting question. So, leadership, I personally believe, is subjective. And more often than not, it's people skill.
Right.
But recently, some people have challenged it. Like, for example, there are two different leadership styles on a broad basis you come across. One leadership style is of Mr. Elon Musk, one of the greatest entrepreneurs of our time. Cutthroat, doesn't think twice before firing people, have these crazy ideas and miraculously make them happen. So
Right.
I don't think he's even immortal. But yeah, so that's one leadership style, which is extremely aspirational for
Right.
most of the founders. But then there's another school of thought, or another leadership style, which comes from the great Mr. Ratan Tata, who's an Indian entrepreneur and one of the most loved entrepreneur. And Ratan Tata, on the other hand, is on the opposite side of the spectrum, because he leads more by empathy.
Right.
And it's like, for him, the loyalty is the most important thing in a person. So even if you might be 80% efficient versus the other person, but if you're loyal to him, the chances of him working with you are much higher than with the other person.
Right.
And because he comes from a school of thought that every company has its own DNA, has its own culture. And even the brightest people might not be able to adapt to it, whereas
Right.
some people who might not be that efficient might still be a completely cultural fit. And it takes years for people to adhere to the culture. But so
Right.
once you adhere to it, you have earned his loyalty, and you have shown loyalty towards him, and you've earned his respect, and then you're going to stay long term. So these are two extreme schools of thought. Now, of course, I try to, for me, try to inculcate best of both worlds. So try to balance it. So for me, leadership is essentially two things. One is resilience, because once you're building the company, it will be a Murphy's Law. Whatever you expect to go wrong will go wrong.
Right.
So it'll be a nightmare process for years and years. You will get punched on the face every morning. It's unbelievably difficult. So resilience is something which every founder needs. And both these entrepreneurs, Elon Musk and Ratan Tata, are extremely resilient. But the second and the most important thing, personally for me, is the empathy.
Right.
And empathy is actually two folds. One is the emotional empathy,
right,
and one is the cultural empathy. Now, emotional empathy, everyone understands. You need to be nice to people, understand where they're coming from, show love, respect, and get the best out of them. So that's very important. But second is a cultural empathy, because the way employees work in the US and China is very different from the way employees work in Thailand and Indonesia.
Right.
Try using the same playbook of these two countries in this part of the world, you're going to fail tomorrow. Good luck. It's not going to happen.
That is true.
So cultural empathy, because Southeast Asia is a region, but every market is different. So you need to understand the people's behavior in each of this market and reciprocate accordingly.
Right.
And unlike what few founders want to do, like my way or highway, personally for me, it doesn't work. The more respectful you are towards the culture, and the more comfortable you make people feel in this part of the world, while still setting strict guidelines and ambitious targets, the chances of you succeeding are much more, rather than stick or carrot, that kind of policy. It more often than not, it doesn't work. So for me, it's resilience and most importantly, cultural empathy that I use. And that essentially kind of shows in most of the teams. So we have a very good retention rate as well. So I'm happy that so far it's working well.
So you have an inner Elon Musk and inner Ratan Tata in your brain fighting for it.
Those are tough shoes to fill, but
that is true.
Yeah,
but,
yeah.
I think those examples serve well in terms of defining the two extremes of leadership styles and how there's a balance that can be found in our personal journeys as well. Now, jumping back to the larger startup scene. So the word funding winter has been thrown around a lot last several months. In fact, last couple of years, I believe. So in that context, what have you seen in terms of your experience helping startups raise funds? And is there anything startups should be doing differently if they want to raise funds in this climate?
Funding winter, like there has been dearth of capital investments recently, and I was reading data from Traction, from $12.5 billion approximately in 2022, it dropped by 65% to $4.3 billion, and 2024 is not looking very different. Definitely the number of investments into startup has significantly slowed down. And personally, my opinion is that it's going to continue like this, at least for the remainder of this year, or maybe until Q1 next year. And hopefully by Q2, I hope, fingers crossed, no more war happens, but by Q2 next year, hopefully things will get better. Right. Now, coming back to your question on what should the startups do differently. First is know thyself. That's most important. So when you are raising capital, you have to be familiar with two T's. Now, what are these two T's? First T is track record.
Okay.
And second T is traction. So if you have a track record, or if you don't have a track record, it's your first company, you naturally have very low chances of raising capital. While if you have previously built a successful company, or you have been a C-level exec at any of the FAANG companies, the chances of you raising capital are higher. Even better, if you have previously built and exited a scalable company, then your chances are even higher because people are willing to take a bet on you. But if you don't have any of these track record, then it's still a very difficult process to raise in these recent times.
I see.
But everything to answer to all the questions is, when you're fundraising, is traction. Okay. So even if you don't have a track record, but if you have built a company which is growing 40% month on month,
right,
you'll still raise, because then you have something which every startup is looking, or every investor is looking for,
right,
is a company which is showing hyper growth. So if you have 40% growth rate, 30% growth rate month on month, the company is growing strong, the company is doing revenues, you'll still get funding no matter what kind of track record you previously had. So yeah, know thyself, understand which, create a graph and map yourself in that graph, where do you put, and based on that, set your expectations. Because sometimes we come across startups who are still assuming the market is like 2020, right. 21, their valuation ask is still super high numbers, and they don't even have a product, and they expect to raise $2-3 million right. in this part of the world at a $30 million valuation, right. which is no longer happening. So know thyself, that's one. Second is identify the right kind of investors. There are multiple kind of investors: angel, family offices, private equity firms, venture capitalists, of course, and other forms of financing as well. So based on the nature of the business, understand which kind of financing would be best for you. Not all businesses are meant for venture capital, right. But that doesn't mean they are not good businesses. They can still be highly profitable businesses. Right. But it's just that the VC money is not for them. So sometimes, like one of our clients, even despite in 2023, when funding winter dried up substantially, they were able to close the round in 45 days. How? Because the founder was super smart. He understood the market, did his own mapping, right. and then contacted 3 potential strategic investors, which he feel he could get benefit from, and he could benefit themselves. Right. And guess what? Of that 3, 1 person committed, and in no time they got the seed capital in 45 days, record time. So identifying the right kind of financing is very important. Right. And most important, cold outreaches don't work anymore. So always ask for warm introductions when you are reaching to any kind of investors, because investors are spoiled for choices today. Right. And there are more startups raising money than ever before. Right. So it's very difficult for you to get their attention if you're just doing cold outreach. But if it is through referral, your chances increase exponentially. So that's second. Third is, and this really bugs me because most of the startups are not following this, is that always be DD ready. DD is due diligence. Right. I see you'll be shocked by the numbers, but we work with multiple startups and investors, and we've seen so many deals closely. Like 60% deals fall apart in the DD stage. Right. And more often than not, why? Because startups are not ready. Investors are asking them questions. For every question, they are taking like 1 week, 10 days to reply. Their financials are not up to date. Their KPI reports are not up to date. And what happens? Because the DD process is taking so long, over a period of time, the investor loses interest. Because investing is a very, I'll say, investing happens, there should be a certain momentum. Right. And it's a very emotional thing. If an investor is excited by you today, he or she might not necessarily be that excited 2 months later. Right. So don't lose that momentum. Make sure before you start pitching to the investors, your due diligence room is ready, so that if you do a great job pitching, you should double down and capitalize on it by opening the data room so that they can look into your company in more details and eventually decide whether to invest or not. But if you are gonna just be ready with a pitch deck and then say, okay, we're gonna prepare these reports when somebody asks for it, and then you're gonna take 4 weeks, I'm telling you, there's a 90% chance the deal will fall apart. So always be DD ready. Then that's third. And fourth, and most importantly, is explore alternative sources of financing. You just don't need equity financing. Now there's many other options available in the market, right. like venture debt, like revenue-based financing, like invoice factoring. I can go on and on. Right. Where if your business is generating cash flows, then there are other forms of financing with a non-dilutive form of financing that you can explore. Right. And I'm shocked how less familiar quite a few founders are for these kind of financing. They always think that the only way for them to get money is through equity financing, right. which is not the case. And if you look at the data, I don't have the exact numbers with me at the moment, but debt financing continues to be strong. Debt financing might have dropped a little bit, but it no way has dropped to 65%, which is equity levels. Right. So the chances is that if you're targeting that form of financing, your success rate increases substantially over looking at pure equity. So these are my 2 cents. So all these 4 points: know thyself, That's one. Second is identify the right kind of investor. Third is always be DD ready. And fourth is look for alternative financing options as well. So that will help you manage your cash flows efficiently.
Interesting. So those are four, I think, a good condensation of things that a startup should know. And I think these are valuable learnings, especially for first-time founders, because they haven't been through that journey. And like you mentioned, there's a lack of awareness or understanding about what they should be doing, they should not be doing, and what options they have in front of them. So I appreciate you sharing that insight as well. So during this conversation, we've talked about differences between different regions, and we've talked about differences between different startup stages. Now, there's one more difference that I want to ask you about, is differences between industry verticals. So do you have a list of what's hot and what's not, especially when it comes to raising funds in this climate?
Yeah, I'll start with what's not. Metaverse is definitely what's not. Nobody's putting a dime in metaverse anymore. So that's not hot. But let's talk about what's hot, which we see in the market today. So no points for guessing. Generative AI tops the list. And there have been decades of work behind it, but now it's finally visible. And I can go on and on, but most of the people would be familiar that it's the hottest sector today, and it is a buzzword. But quite a few really, really significant developments have happened in this space, which people are using today. So that continues to be hot. Second sector, which we see in the market is still gaining a lot of traction, is health tech. So even if you look at the data, despite overall funding dropping by 65% 2022 to 2023, health tech still remained robust, and there was a 10-15% decline only. So in this sector, capital continues to flow in, because it's a massive room for disruption there. Medicines are expensive, so many diseases are still non-curable, so people are still willing to, and even the supply chain is broken, so a lot of investments are happening in the health tech space. Then third is, apart from health tech, it's fintech. Of course, it continues to be hot. Fintech, today publicly traded value of fintech companies is around $550 billion, and it is expected to double in size over the next 6 years.
Wow.
Right. So this industry almost doubled in the last 5 years. So 2019, the number was around 250, which increased to 550 by 2024 today, and it is expected to double again in 2030. So fintech, there are a lot of areas of disruption there, so it continues to be hot. And last is, for me, is climate tech, ESG related startups. And that continues to attract a lot of capital, because climate change is real and there's no point denying it. And there are a lot of funds who have committed a lot of capital. So I think that industry will continue to grow. So far in Southeast Asia, climate tech hasn't grown at the pace at which it has grown in the European market. But typically Southeast Asia has always stayed 3 to 5 years behind Europe. So I think over the next couple of years, you'll see a lot of action happening in the climate tech space in this part of the world as well. So these are my few picks.
Understood. You want to maybe dive deeper into a list of not hot?
I mean, the biggest point is it might not be hot for VC investment, but it still can be a very meaningful business. Let me tell you, the most boring businesses actually make the most money. So if you start a small service business, the chances of you making it $1 million, $2 million, $3 million revenue business is so much more higher than going for a long shot of getting a scale and with you getting mass market and then reaching to that level. So I don't think any business is bad. If you have a passion for anything, everything is hot. But it might not be good for VCs, but VC is a cyclical industry. So I will not answer this question honestly, because I don't personally think any business, e-commerce today is very saturated, but you can still build a very sizable e-commerce business if you are targeting the right niche or the right market. So not everything is hot. It might not be conducive for VC's investment today, but it still can be a good business. So try everything. Try where you believe there is a market.
I appreciate that insight, because you're right. There's no point demotivating people who might be doing a great job otherwise,
Exactly.
just because they might have trouble raising in this climate.
Exactly. Like I'm one of my very close friends runs a recruitment firm. And I got to see his revenue numbers. I literally fell from the chair because we work with a lot of HR tech companies,
right,
who are valued at $200 and $250 million today. They're still burning capital, and their revenue is like significantly lower than my friend's revenue.
Right.
So what would you want to build? One thought is, not many people know that gentleman, but I know for a fact how much money he's making.
Right.
So today, if you start a recruitment company and you'll go to a VC and say, hey, invest in my company, they'll say, no, it's not a VC backable business. Go away. That doesn't mean it's a bad business.
Right.
It's just that it's not apt for VC investments because they have a certain IRR deliverables towards their LPs.
Right.
And they're always looking to 100x their investments, which the recruitment business might not be fit to produce.
Understood.
So yeah, try everything because there's a market for everything. You just need to do it right.
That's hopefully motivating for a lot of people who are hearing this. And now we get to the last question. I've been following Wows Global very closely on LinkedIn, and I know for a fact that by the time this episode airs, the new and improved version of the Wows Global investment platform would be live. Can you give our audiences a little peek into what the new platform is and how it is helping startup founders in this region?
Yeah, thanks for that question. So we've been in business for roughly 2.5 years now. And when we started in a quintessential, non-scalable way, because I was trying to understand nuances behind each of the operational process of the business. It took us a while, and we've been building this new version behind closed doors for roughly 8 months now.
Wow.
And I'm very happy with our output. So if I have to summarize what we are trying to accomplish with this new Wows investment portal, is that we are essentially building an operating system for private markets. What that means is that we work with venture backable businesses and assist them with primary financing, aka raising fresh capital. We also facilitate alternative financing like venture debt, term loan, revenue-based financing, etc. And last but not the least, we also facilitate secondary transactions to solve the liquidity problem, but that's applicable for mid to late stage companies, particularly Series B and beyond.
Right. That's
what we do. Now, how do we do it? So there are two parts of our core offerings. Now, first part is tech stack. Now, if you go to, I was seeing a LinkedIn post a few days ago, somebody has given you a tech stack for startup fundraising. And there was equity management, there was virtual deal room, there were investor matching, and there were portfolio management. So many tools options available.
Right.
And what we have done is we have combined all these different tools into one consolidated platform.
That's nice.
So we are the first platform in Southeast Asia, in fact, even in Asia, where we have brought in all the tools together to give you a seamless capital raising experience from start to finish. And that's applicable not just for the startups, but also for investors. So for startups, you can manage your equity, you can manage your ESOPs, you can manage your listings, you can manage your fundraising objectives, and you can also manage your investor relations. For the investors, they can manage the deal flow, they can do the due diligence, and even the post-investment, they can manage the portfolio. Not just limited to the companies invested through us, but also the companies which they have direct investments as well, making it a single source of truth for all the parties. So that's one part of our offering. But second and equally important part of our offering is network. Because what we are trying to build cannot be built or serviced with pure technological solution. So what we have built in the last 2.5 years is an extensive network of companies as well as investors. So we work with over 350 institutional investors today, which range from venture capitalists to private equity firms to family offices. And we also work with quite a few HNIs, but that number is roughly 15% of the institutional partners or institutional investors that we have got. While on the startup side, it takes time for us. It took time for us to build credibility in the market,
Right.
because the business in which we are in is based on trust.
Right.
So it took us time, but today we are servicing over 150 companies from seed to Series D stage, and these companies are very carefully curated from almost 2,500 companies. So we believe that with this new tool, with this new version, it's going to increase the user experience seamlessly, while also allow us to service not just the companies in our network, but also the companies outside the network. Now, for those who want to learn how we will be doing it, they can reach out to our customer support team.
Awesome. Make sure you do that. So with that, Gagan, we come to the end of the interview. I've learned a lot from you, hearing you speak at events in public and through our conversations and networking events. And I'm glad and grateful that you took the time to speak with us today. So thanks again, and we'll hopefully be talking more.
Thanks, Ben. Thanks for having me. It was a wonderful experience.
And thanks to our audiences for tuning in. We will see you in episode 2.